Guess who's back again. It's $BG, and I'm back. I know, it's been, what, 2 months or something? I think it may have been 2 months, you know. And yeah, all I can say is China are flipping plonkers. Because obviously my part broke, had to order a new part, bomb from China, took flipping 6 weeks to arrive. Let's have a look at the S&P. And today it's up, look, 0.39%. Lovely jubbly. It was actually down. It was down about 0.9% at market open. No, it was looking a little bit risky whiskey, but no, it's up 0.39%, which is good. Let's see the Nasdaq. The Nasdaq up 0.71%. Yeah, it's always about double up from what the S&P is, roughly. Around about that. The Dow, I don't even pay attention to the Dow. It's up 0.16%. Jim Cramer loves the Dow. I don't really pay attention to the Dow, to be honest with you. And the Russell's up 0.38%. Look at that. We've had a nice little just spike since the market opened, which is brilliant stuff to see. Of course, you've got gold there up 0.55%. And you've got oil up 1.2%. More inflationary pressure. Not great, but oh well, what can you do? Now, anyway, I came across something very interesting. Of course, people are expecting a recession, aren't they? You hear recession this, recession that, inflation this, inflation that. So I'm just going to have a quick little look. Now, this is the sector performance year to date. So this is for 2022, look. Let me just reload it because it might not be up to date for today. So year to date for 2022. Look at that, energy. Best performing sector in the these are all the sectors in the S&P 500. Energy, look at that, up 59.95%. You've got utilities next, up 3.77, and then you've got materials down 3.84. So only 2 sectors are actually up in the whole of the S&P, which is just pretty nuts. But yeah, and look at the bottom ones. These are ones that are lagging 20%, 24% for communication, and 24.7% for consumer discretion. So everyone bangs on about technology stocks really down, but really and truly, consumer discretionary, woof. So yes, anyway, just pay attention. Look, the top 3 performing sectors, energy, utilities, materials, year to date. Now, this little thing here is best performing sectors from 2007 to 2021. So obviously it's a list, look, information tech in 2019, and you had that. So it's just a list of how the sectors perform. And then you've got the S&P 500 as an average, which is obviously the average of all of them, aren't they? But yeah, 2007, let's have a little look. Obviously the year before the Great Recession, energy the highest, materials, then utilities. Awful familiar to what it is today, year to date. Just something quickly to point out. Obviously in 2007, the highest were energy, materials, utilities. All inflationary, aren't they? Energy, your oils, your petrol, diesel. Cost of that went up, so the energy stocks went up. Inflation. Materials, your prices of lumber, bricks, aluminium, steel, metals, anything. Anything material-wise, bomb. Stocks performed very well because it was high inflation during 2007, and materials were very, very good. Utilities, again, prices of your electricity, your gas, your water, all your bills, up 19.4% because it was a high inflationary period. So the prices of things went up. And that's the same as we're seeing year to date, look. No wonder why these are the top 3 performing sectors, because energy, bomb. We know that the price of the pumps have skyrocketed, and that's why it's showing in the stocks, look. Utilities, again, we know that inflation's very, very high, and the prices of your water, all your bills, your heating and that is going to go up, and that's why it's performed well. And materials, again, high inflation are going to mean that these 3 sectors are going to perform extremely well. And that's exactly what's done year to date. And what happens with high inflation? The Fed have to raise interest rates. They have to combat the inflation through a recessionary period, through raising unemployment, for people losing jobs, so there's less spending. So all this starts coming back down. That's what will have to happen. That's what's going to have to happen. And unfortunately, people will have to lose their jobs. And the Fed knows that. That's why a recession will come of this, in my opinion. Of course, I could be wrong, isn't it? I'm not saying I'm right. We could have a flipping boom market period, you know. People are saying there could be a boom period still. But I'm not a believer in that. Consumer staples came in at 5th in 2007. And consumer staples is 4th this year. So it just goes to show that actually the sectors that are performing well are the same sectors that performed well in 2007. And a year after 2007, the big recession, and I predict that a recession is coming in a year to 18 months anyway. So, not saying that I'm right, but you know, hint, hint. Anyway, 2008, look how the year happened. Let's see what sectors performed well in 2008. Consumer staples down 15.4%, but performed the best. So the best sector was still down 15.4%. So that just shows you how awful 2008 was. I mean, it was a dreadful year. I was only 5 years old when this was happening, so obviously I wasn't really paying attention to any of this. But financials are bottom there, minus 55.3%, and the S&P or the average was down 37% for the year of 2008. So to avoid this, where can we put our money? You know, if we're correct, if these three sectors, if there is a recession coming up in a year's time, where can we put our money? Interesting thing I came across. Let's have a look at the Fed's interest rate. Boom. The Fed interest rate, it dropped on September the 18th, 2007, so just before 2008. Let's see what happened to the S&P. So let's go over to 2007. So where's September? There it is. Look, September the 17th, 2007. So the S&P was here, trading at nearly all-time highs. I mean, look, we were very high up here. And of course, we know what happened in 2008. So when the interest rate dropped, it was here. A year and a half later, so what's 18 months after September? Yeah, so March. So it'd be March 2009. So a year and a half later, after September 2007. Where were we? We were here, right where this yellow line was. So if you'd have sold your S&P, waited a year and a half after the first interest rate drop, then bought back in, you'd have timed it to perfection. But of course, we want to sell our S&P. We don't want to leave money on the sidelines. We don't want inflation to eat up. We want to stick it in something where we can still earn more. Then we can watch the S&P go down and then buy back in with even more money because we've earned. Okay, so now I want you to take a look at gold. Right, so where was September the 17th, 2007? Here. So if you'd have bought into... So we sold the S&P when they lowered the interest rates, September the 18th, 2007, and we bought into gold. A year and a half later, so March 2009. Where were we there? We were here. And my mum's doing the hoovering, but hopefully you can still hear me. That is some background noise you're going to have to deal with. But anyway, as you can see, we buy gold here, we sell it all the way up here. So we've just made all this, and then what do we do? Well, we sell it, and we get back into the S&P 500 at these lows. Perfect timing of the markets there. And it was when the interest rates fell. But when they lower interest rates, obviously the Fed is so-called dovish then, and you'd hear all the financial YouTubers tell you to buy. And it clearly goes to show that in 2008, you would have lost a lot of money if you bought in heavily when the interest rates dropped, because the S&P, you'd have been buying at all-time highs. And you'd have just had to deal with all that. And it didn't even come back to these sorts of levels till 2013. So if you bought in when the interest rates dropped September 2007, you'd have made no money till early 2013, like January 2013. So that would have been very, well, just atrocious. You don't want to be doing that. Just to quickly point out as well, it didn't just happen in 2008. When they lowered the interest rates in 2007, 2008, the markets dropped. And you're probably thinking, well, yeah, maybe it was a one-off. You know, well, let's have another little look. This was in 2000, so 8 years previous to this, the last sort of big sort of drop in the S&P. Boom, look at that. August 2000, they dropped the interest rates. Only by 0.04, but they still dropped the interest rate. So let's have a look how that affected the SPY. Well, look. August 2000, look, again, we're at all-time highs. And what happened after they dropped the interest rates? Pfft, look at that. You had 3 years of just markets just going to turmoil. Yeah, look, bomb, just straight down for 3 years. And of course, what did they keep doing in those 3 years? Well, look, they kept lowering the interest rates. Look, 2001, January 2002, look, they sort of halted it a bit. But all through 2001, look, they were lowering the interest rates. And all through that's the start of 2001 here. All through 2001, look, the market dropped. So it just goes to show that when they do drop the interest rates, the market has gone astronomically low. But it doesn't happen every time they drop the interest rates. They have dropped the interest rate and the market has gone up. But this is where I think it's slightly different. When they drop the interest rates and you're expecting a sort of big sort of recession and they drop the interest rates, that's when the market plummets. Okay, like in 2000, boom, the markets plummet. In 2008, boom, the markets plummet as soon as you drop the interest rates. I see the same thing again. As soon as you drop the interest rates, boom, the market will plummet. Just because inflation was so high. You know, this is going to be quite a severe sort of recession in my eyes, obviously. So I'm just waiting for the interest rates to drop, and I don't see that coming for at least another 18 months. I don't see an interest rate drop at least another 18 months. because inflation's still roaring high. So I don't see the market bomb doing a drop at this sort of level. I'm talking with the S&P drop 50% for another 18 months or so, which is why I'm still a buyer in this market right now. But best believe when the Fed starts turning dovish, best believe when the Fed start possibly hinting at an interest rate, a lower interest rate, and best believe when they actually go and do that, yeah, I'll be selling. I'll be moving into gold when that happened. Anyway, that was just to prove to you that it just didn't happen in 2008. It happened again in 2000, and I think it will happen again in the future. So yeah, that just goes to show interesting findings there with the sectors, how they're performing. Let's have a quick look on the S&P right now for today. Oh, it's up 0.3%, so it's dropped a little. Well, yeah, it's just sort of petered out. But anyway, the Nasdaq, see what the Nasdaq is saying. Up 0.7, up 0.56. So yeah, it's normally just double the S&P roughly. So yeah, and I won't bother with the Dow or the Russell because not many people actually bother with those sorts of, well, especially the Dow. People buy the Russell, but not really the Dow. Anyway, that is all for today. US market's closing in about 5 hours, so we'll have to see how today does play out. But they're on the way up. They're green, so that's at least a good thing. And yeah, I'll see you in the next one.